Hello, everybody. Good morning, good afternoon, good night, wherever you are in the world. This is our latest update to our Lunch and Learn webinar series. My name is Mayur Thaker. I am an equity strategist here at Zacks Investment Research, and today we are talking about Comcast, ticker CMCSA, and the investment thesis in a nutshell is quality at a great price. So let's talk about Comcast, one of the most interesting and kind of one of the most taken for granted companies out there that represents a mix of old school and new school. So let's take a look at who they are, what they do, and why we have just recently added Comcast to our flagship Zacks Earnings Certain Proxy portfolio. So let's get started. So quick background on the company, but before we do that, just the core investment thesis that I have that I wanted to present to everybody here today is that we believe right now Comcast shares offers a very highly attractive combination of two things. A combination that is quality, and if you've been following us on this channel for the last several months, years, you have a pretty good understanding of how we define quality. But in a nutshell, and I'll have this on a future slide here, but quality is the combination of four factors that we look for: earnings linearity, earnings growth, free cash flow conversion, and return on invested capital. We believe that these four principles covers basically all of our bases when it comes to identifying what a high quality business is, in our view. So this is a company right now, Comcast, that we believe exhibits all of the characteristics of quality that I just mentioned, all four, but at the same time also trades for a highly attractive price, which is rare because high quality companies rarely go on sale. It's well known that they are high quality, and that's why investors pay a premium for these companies. But every once in a while, companies that are in this realm of high quality do go on sale. And right now, I believe Comcast is one of them. And this is why we just added it to both the flagship portfolio, that's the Zacks Earnings Certain Proxy. That is our main portfolio of all the companies throughout the entire U.S. large cap space that we believe represents the highest caliber of quality. And also a subset of that portfolio is the Zacks Earnings Certain Admiral portfolio. This is a smaller portfolio of 30 companies, and we added it to that list as well as of the Q3 update that went out to clients on September 30th. So a brief history of Comcast. This is a company that was started in 1963 by a man named Ralph J. Roberts, among other co-founders, and they were originally called American Cable Systems. And as most of us know, it started off with cable TV, and cable TV started to gain popularity in the 1970s. Really, it started in the late 60s. Because it allows people to receive longer distance television programming versus traditional TV top antenna. If you have seen them, I'm not old enough to have seen what TVs look like in the 70s, but we've seen them in movies and TV shows and on social media. The old rabbit ears that people used to put on top of their old TVs. Or even rooftop antennas. So cable TV started to offer significant advantages in that people could watch longer distance TV programming that is outside of their radius for receiving broadcast radio signals. And so that started to grow quite rapidly in terms of adoption. However, American cable systems always had trouble gaining clients. They always had trouble gaining customers. Cable TV at the time was very, very fragmented. There was not a lot of centralization, not a lot of universal agreement as to the standards that would be followed. And so there were scores of locally owned cable TV operators. And so American Cable Systems never really succeeded in gaining customers. In fact, the CEO and co-founder Ralph Roberts, he actually said that they used to go door to door, knocking on doors and pitching them in the old-fashioned way. And they got some customer growth through that, but just not enough to really scale, right? So what they did is they decided, let's start an acquisition binge. So their method of attracting, or at least growing the business, ended up being through serial acquisitions. And this was always a part of their DNA from the very beginning, and continues to be so through the 90s, through the 2000s. I remember personally growing up as a kid in the 1990s, we had our local cable TV operator. It was called Cable TV Montgomery, here in Maryland, where I'm located. One day, Cable TV Montgomery went away, and it was all Comcast. And I remember, seeing that myself, and I was kind of upset that happened, but, it didn't really make a difference because, TV programming never really changed. And so Comcast always had that sort of, methodology or approach to growth, the M&A approach to growth in their DNA from the very, very beginning. And so they experienced rapid growth through the 70s, 80s, and 90s, mostly by acquiring small cable operators. But they also made a couple of really big M&A decisions with McLean Hunter in 1996 and Media One in 1998. That was two massive corporate actions that more than tripled their subscriber base. So again, this was a rapid period of growth for the company. And in 2002, they expanded into high-speed internet. Just as the internet age started to really, really gain steam. It started in the early 2000s, but they formalized high-speed internet services via the DOCSIS technology. That's the technology that, if you remember in the early or the very late 90s, actually it wasn't even in the late 90s. I think it really started around 2000, maybe 2001, where cable modem internet started gaining popularity because it was significantly faster than the dial-up, modems that, were popular during the age of the internet in the late 90s. If you remember the old, the sounds that they used to make, I'll never remember it as a kid when I was dialing up to connect to the internet, to AOL. Back then, that was a thing that only a certain generation will ever know about. Today's kids will never know about that. But those old dial-up modems were then, completely replaced, thanks in part to Comcast and their innovation in bringing DOCSIS technology, which is the cable modem technology, in 2001, 2002, to the masses. And that's what really caught, like wildfire throughout the entire country and, eventually overseas as well. And that's what, for the first time ever, provided high-speed internet. Before, we used to have to wait a long time for websites to load and for downloads to finish. And then, Comcast came in with DOCSIS cable modem technology, and that changed everything. So once we had high-speed internet, that allowed the internet to really develop into a much richer content experience. Because internet speeds were kind of the limiting factor in our experience of the internet. Later in 2011, Comcast launched Xfinity streaming services. That was their answer to the rise of streaming. So one big thing about Comcast is that they did recognize changes in trends. Remember, Comcast before 2000 was purely a cable TV company. So TV programming was their bread and butter, and their original cable TV service is what sold the vast majority of the revenue. That was entirely their revenue for 3 decades plus. And but they started to realize that, hey, there are these new sort of media that is rising. There was YouTube in the mid 2000s. I remember that, being in college, everybody in college, looked at, started watching YouTube. And then there was Netflix as well that, by 2011 was gaining, very fast traction. And so, Comcast tried to make sure that they aren't entirely left out by launching Xfinity. Obviously, Xfinity has not been anywhere close to being as popular as YouTube and Netflix, but it allowed the company to remain relevant. Rather, it allowed them to not be completely disrupted by these new emerging streaming technologies. So Xfinity was kind of their placeholder to allow them to continue to compete in a very, very competitive market. However, remember, that is just on the TV programming side. We're going to talk about exactly how Comcast has been able to fend off, significant competition from YouTube and from other social media too, not just YouTube, as well as Netflix. But Comcast, because of their pivot in the early 2000s to be a all-inclusive service, where they not only provide cable TV programming, but also internet and phone, to be a sort of all-inclusive bundle of home connectivity, that allowed them to continue to stay competitive and to fend off the rise of these new streaming services. And then in 2013, they entered media broadcasting. Remember, they were, originally a bundler and distributor of cable TV content, as well as phone and internet service provider. But in 2013, they officially entered the thing that they originally just delivered, which is the media. And they purchased NBC Universal from GE for $16 billion. They also bought other networks too, like USA and Sci-Fi networks. These are also TV channels that were at least popular among cable TV subscribers. In 2015, they launched Xfinity Mobile Wireless Internet Service, continuing the long-term secular trend of mobile service. And then in 2020, they launched Peacock as its answer to the global rise of streaming versus traditional cable TV programming. So Peacock, they've been able to leverage all of their content from NBC and other assets that they own, and have put them all on Peacock. And Peacock is now actually gaining steam. People originally doubted the ability of Peacock to actually get traction because it's kind of another Me Too service. Remember, Me Too services rarely succeed. And, there's a little bit too much fragmentation too. Like every TV channel has its own streaming app. And, people just don't like to have 6 or 7 different streaming services. They, consolidate with 1 or 2, and that's it. And that so far has been Netflix and YouTube as the 2 big streaming services. But Peacock has held its own, and we're going to take a look at exactly how well that's doing. So again, how does Comcast make money today? So let's break it out into very 2 plain vanilla sort of descriptions. First is their connectivity and platforms division. That is their broadband and wireless connectivity services. That's branded under Comcast Xfinity in the US and Sky in Europe. And this represents 2/3 of the revenue at over an $80 billion of annual recurring revenue. This is actually one of the reasons why I think Comcast is so attractive right now. Because remember, these are not repeat sales. This is true ARR, right? Annual recurring revenue, because this is subscription revenue. And it's also revenue that's very sticky. Once you have Comcast, say Xfinity for internet, people don't cancel it. Everything has, evolved around connectivity, internet connectivity, especially high-speed internet connectivity. Even with the rise of new technologies like streaming, and now with the rise of AI, internet is going to be ever more important. And so the reason why, I think Comcast is a prime candidate and a prime really has a hand-in-glove relationship with the rest of the Zacks Earnings Certain Proxy is because what they provide is a necessity. It's not a discretionary purchase. And it continues to be necessary with the rise of new technologies, including artificial intelligence. The need for high-speed internet is as high as it's ever been, and that isn't likely to change anytime soon. And it's also 2/3 of their revenue at over 80 billion annual recurring revenue. They also earn very strong margins. So it's not only the biggest part of their revenue, it's also where they earn their highest and most lucrative margins. So connectivity and platforms overall earns about a 42% adjusted EBITDA margin. This is as of the latest quarter in Q2 of 2024. The other side of their business, we also know about media and entertainment businesses, which includes the NBC Universal and Telemundo TV and streaming platforms. It also includes Peacock, right? The app, the streaming service where they have all of their entertainment content. And they also obviously own film production studios and theme parks. People don't think of Comcast as a theme park operator, but they actually do compete with Disney and Six Flags, with Universal Studios in Hollywood, Universal Orlando Resort, and several other resorts also overseas in Singapore. And all of this represents about 1/3 of their revenue at about a 40 billion annual run rate. So this is not recurring. Some of this is recurring, but most of it is not. Obviously, Peacock is recurring revenue. So that's very, very attractive again. But for example, theme parks, that's not recurring revenue. And advertising revenue is not recurring either, because that does depend on, bigger macro concerns like the business cycle. Advertising revenue tends to go down during recessions and bounces back during upswings. But advertising revenue is also susceptible to technological disruption, because as we know, people are not really watching cable TV as much, and people are not really watching in general TV as much, NBC, Telemundo, and so advertising revenue tends to go down if viewership declines. But despite that, this is just 1/3 of their revenue, and it's also where they don't earn the best margins. It's about 18% adjusted EBITDA margins, again, as of the latest quarter in Q2. We're set to get the update of Q3, I believe, next week. So we'll see where that goes, but I don't expect it to change all that much. So the reason why people are really nervous about Comcast is because, in general, this has been an industry-wide concern, and we're going to talk about that a little bit later. But this is just a quick breakdown of how they earn revenue. And as we understand how Comcast earns revenue, it actually bolsters the investment thesis, because again, 2/3 of the revenue comes from highly required and recurring services, broadband and wireless internet connectivity. That is, again, where they earn most of the vast majority of their revenue, and it's also where they earn the highest margins. So that is bullish in my view. Now, unpacking Peacock a little bit, Peacock streaming service just surpassed 4 billion in annual recurring revenue. Again, this is a subscription service, and it surpassed 4 billion in Q2 of this year, and it happens to be Comcast's strongest growth driver. It grew 28% year over year across their portfolio of assets. So Peacock right now is their strongest growth driver, and it's also where they want to pivot the most, because that's where where Comcast believes they can compete with the way consumer choices are changing away from cable TV and traditional media towards streaming service. So again, as I was saying earlier, quality, the way that we define it, in terms of how we manage our portfolios is a collection of 4 principles. Earnings linearity. Earnings linearity basically looks at the question of how durable is the company's earnings. Do they have susceptibility to macroeconomic events? Do their earnings go up and down with interest rates? Do they go up and down with the dollar? Do they go up and down with commodities prices? Do they go up and down with GDP? Do they go up and down with other macroeconomic factors? So linearity looks at how cyclical is the company, how volatile are the company's earnings. So it's not just a function of macro, but it's also a function of consumer choices. Is there a lot of consumer choices available? Is there high or low price elasticity? Do customers bounce back and forth between Comcast and their competitors? So earnings linearity in a nutshell looks at how durable has the earnings growth been over long periods of time. So that goes hand in hand with that next principle, earnings growth, which basically, again, that's obviously what everybody looks at. How quickly have they been able to scale and grow the bottom line, which is ultimately what rewards investors in the long run. But also, are they earning that, or are they generating that growth in a capital efficient way? And that goes into the third principle, which is the return on invested capital. Does the company earn attractive returns per dollar of capital that they invest? Because remember, especially for companies that are serial acquirers like Comcast, we want to be judging them not just on growth, not just on linearity, but how efficiently have they deployed capital? How efficiently are they allocating capital? So for a company that grows quickly through acquisitions, you can show the growth, you can show the linearity, but what if you're spending a lot of money to generate that growth? And so ROIC is sort of the BS detector to make sure that they aren't overspending on growth. Because you can go out and make a very big acquisition and pay 50 times earnings or 60 times earnings, and that would be a very poor return on invested capital, even though it generates growth, even though it leads to linearity. But if the return on invested capital is very poor, it means that the company is making poor capital allocation decisions. So we want to make sure that ROIC is high and sturdy as well. And then lastly, the above 3 items are all predicated on earnings. And earnings, although are very, very important, earnings are subject to accounting irregularities. And free cash flow ends up correcting for that, because that's ultimately the cash that the company generates after all expenses are paid. So it helps us reconcile accrual accounting towards cash accounting. So we want to make sure that the ratio of net income to free cash flow is high and strong and sturdy as well. So we believe that by combining these 4 characteristics, we ultimately end up with a collection of companies that exhibit the highest characteristics of quality. And then lastly, value. And right now, for most companies, we don't always get that. If you've looked at the portfolio of companies that we own in the Zacks Earnings Certain Proxy, they are very high quality companies, very durable business models, exceptional returns on capital, and exceptional free cash flow conversion, but they don't trade at cheap multiples, right? Quality is usually well rewarded with high multiples. So it's rare for a company that exhibits all 4 characteristics of quality to also trade at a cheap multiple to earnings and free cash flow. And currently, Comcast exhibits both of these categories, quality and value. So let's take a look at the first 2 principles of quality. Here you can see exactly how linear the growth of the company has been. This is a chart of the company's earnings over time. And here you can see from, over the last 20 years, earnings have gone up in essentially a 45-degree line up. You saw a little bit, due to the pandemic, right? A lot of things got disrupted with the pandemic, so we're looking past that as a one-off because, the pandemic was different from any other recession in the sense that, people were forced to shut down, which really, ended up, messing a lot of things up because if you look at it, look what happened in 2008. That was even worse of a recession if you look at it in terms of objective numbers. That was a nasty recession. But look at how they were able to essentially navigate through that recession with absolutely nothing that happened to their earnings. They continued to grow through that recession. That's what we mean by earnings linearity and earnings durability. They're kind of interchangeable words. So we basically look for companies that have grown earnings over time, over long periods of time, through recessions and through bull markets as well. So, again, Comcast in this one chart, we can see that they have exhibited exceptional earnings durability and growth over the long term. You can see the slope of this line is about 17 3/4. They have compounded earnings over these past 20 years at almost 18% per annum. That is exceptional. And look at it now. Despite, looking past the COVID, volatility, earnings are right back to long-term trend growth. Again, and that assumes almost an 18% compound growth rate over these past 20 years. That is exceptional. And so the question is that we need to ask a why behind it. It's not only good enough to say, yeah, they've had high earnings linearity in the past, but in order for us to have confidence that they're going to continue that high earnings linearity into the future, we need to understand and ask the question, how? How do they do it? And we believe that companies can do this through a combination of two factors. One is that they need to have an economic moat surrounding their business. An economic moat is, something that protects them from competition. And this has been something, a phrase that's been coined and popularized by, the great Warren Buffett and the late great Charlie Munger. Economic moats have been, a big part of their overall business analysis. And ultimately, every company that they've ever owned in their portfolio, their first and foremost question is what's the moat? What is it that they do that others cannot replicate very easily? So there needs to be an economic moat that surrounds the company, and the company must be providing a product or service that is required. So this is very important to distinguish between must-haves and nice-to-haves, right? That's the difference between consumer staples and consumer discretionary. So we like to focus on companies that, provide goods and services that are needed rather than nice-to-haves. So you can have a moat, but also be a nice-to-have. For example, Exxon is a perfect example of that. There's only so many integrated oil drillers and refiners out there. Exxon and Chevron, right? They both have a moat because there are not very many companies that can do what they do at scale. They have very wide scale, they have very wide distribution, very large barriers to entry, very high, upfront expenses. They also have R&D and some of the best, scientists in the world that work for them. So obviously that makes it very difficult to compete with them in a big way. That is their moat. But and it's also required, right? Everybody needs oil. However, oil is highly susceptible to the business cycle. It's highly susceptible to interest rates. And so that's why they go through boom and bust cycles. So we correct for that by looking at companies that have a strong economic moat and companies that are always in demand, no matter what is happening out there. So it's required at the same level all the time. And that's how we can see this chart, be true. Because remember, what does Comcast do that's always required? Internet broadband services, right? That's always been the need for these last 20 years, and most likely the case is that it's going to be continued to be needed. So a moat is created around a business, again, when it has any of these factors: high barriers to entry because of large upfront fixed costs or regulatory hurdles. They could have an advantage in scale. Once you get to a very high scale, you become a cost leader. And at that point, it's very difficult for smaller competitors to enter. You could have a moat because of a big network effect. You can think of Facebook or Google. Network effects are basically that, the more or the bigger their, subscriber base or the bigger their user base, the better the product becomes, right? Because as, more people search on Google, the algorithm gets smarter and smarter and can make better and better recommendations and get you better and better information. Same thing with Facebook, right? If there's only one person, you, on Facebook, why would you ever use Facebook, right? So the more the number of people that are posting on Facebook, the better Facebook becomes from a user standpoint because there's more and more content, right? So that's what network effects is. So that's how a company can have an economic moat. There's also R&D, technological leadership. You can think big pharmaceuticals like Novo Nordisk, which we own in our portfolio. Companies with valuable intellectual property. Again, big pharmaceuticals like Novo Nordisk or Johnson & Johnson. Companies with brand value. That's key. Very, very important. Brands have been able to withstand the test of time. So we own lots of brands in our portfolio. One of them is, for example, J.M. Smucker, a great company with strong brand value. Or companies with any combination of the above. Some companies can have all of the above, like Coca-Cola, for example. They have a very, very strong mix of many of these different forms of economic moats. And so Comcast, we believe, checks off multiple boxes to be a moated business. It's got large-scale distribution to drive down costs, large barriers to entry because of very high infrastructure costs, and that's why it's a duopoly industry. Comcast and Verizon basically dominate that industry of high-speed internet. And so a core principle of the Zacks Earnings Certain Proxy is to pick businesses with a strong moat and who produce a product or service that is required rather than discretionary. We do this because it significantly increases the earnings certainty into the future. So here we saw a chart of Comcast's earnings in the past, and so it definitely checks off our box, is that they were able to navigate and to exit boom and bust cycles basically unscathed in the past. But how can we have confidence that they can do this in the future? And it's because they produce a product or service that is required rather than discretionary, and it's required at the same level year in, year out. People won't cancel their internet because of a recession. I mean, unless at the very fringes, when things get extremely dire, then you would be required to cut your internet subscription. But for most people, that doesn't happen. It never gets that bad, and so that's why their revenue from the biggest part of their business, again going back to this slide, from connectivity and platforms, is not likely to decline significantly, even in a recession. So again, a combination. This exercise overall helps us build confidence that the earnings durability that we've seen in the past is likely to continue into the future. So here, again, going through that entire list of, principles of quality, we saw the high earnings linearity and high earnings growth together in this one chart. And now we see, again, a chart of their return on invested capital, especially as a serial acquirer. This is important to check too. A lot of serial acquirers have very low, unattractive returns on invested capital. Usually it's in the 5 to 6% range. And you can see that during the bottom of the pandemic, when the company was really disrupted because of their secondary business segment, which is media and entertainment, but it's back now to above 9%, and it's actually hitting all-time highs here. That's very important. One of the most powerful ways to add alpha is to pick companies that not only have good ROIC, but increasing ROIC, which means that they are getting more profit per dollar of capital this year than they did in the previous year. That's very, very important. You want to see ROIC increase over time to add confidence that they are generating more and more returns per dollar of investment that they make. That means that the company is getting smarter at capital allocation decisions. They're improving their capital efficiency. Again, very, very important to see. So we love the fact that this is growing. Although it is very stable and steady, it's not rapid growth. But again, growth nonetheless, that's exactly what we want to see. So high and stable ROIC over long periods of time, let's say over 5 years at least, is potentially evidence of a strong moat around the business. So again, companies that generate high returns on capital for many years, this is a very strong piece of evidence that they have a moat around the business. Because if they didn't have a moat around the business and they're generating, crazy good returns on capital, then that would attract competition to come in and compete away that business. So again, if it's a very easy to do thing, and if they're generating really thick returns on capital, then everybody else will rush in to compete that highly attractive return away. That will ultimately drive down prices, and essentially that high margin, high return on capital item would then normalize back to regular levels. So again, if a company can do this for a long time, it means that there's something that they do that's not easily done by the competition. And lastly, in terms of quality, earnings are backed by free cash flow. So this is a chart of free cash flow conversion. This chart looks like it's going down over time, but again, I wouldn't look into that too much. As long as the company, remember, the highest quality companies generate free cash flow conversion something north of 80%. Even 70% is good. So throughout this entire 15-year time frame that this chart shows, they've been well north of that. And so it's not, I wouldn't be too concerned that it's slightly, declining. But anything above 70-75% is golden when it comes to assessing the quality of earnings. And Comcast, as of the most recent quarter, is at 86%. Again, very excellent. Not something that I'd be concerned about at all. So that rounds out, the 4 pillars of quality, which I believe, Comcast excels at, across all 4. But here's what gets really interesting too. It's very rare for a company to have all 4 characteristics of quality and trade for a deep value multiple at the same time. If you recall, I did a big video on 3M earlier this year, back in February, or it might have been March, and I was similarly very bullish on 3M at the time because 3M, like Comcast, checked off all the boxes of quality, and it traded for a very deep value multiple. That was because it was, going through a number of different lawsuits with regards to their forever chemicals and things like that. That was weighing down the stock, but I, believed that, at this point, the company is priced for very, very low to possibly even negative growth for the foreseeable future. And I looked at their core business, and it was strong. It generated positive and growing free cash flow. So for such a high quality global brand that people still recognize and trust, and for a company that continues to grow the core business without any meaningful disruptions to that growth, to that core business that they operate in, for it to be trading at such a low multiple is a great opportunity to buy. And so I put it out that video. You can check it on our YouTube channel. Just search Zacks Pro 3M. You'll see the video. I was very bullish on 3M at the time, and ever since then, 3M is up 75%. since I made that video. Again, it's very rare for a high quality company to also trade at a deep value multiple. And I believe Comcast is in a similar boat that 3M was just about 6 or 7 months ago. So this to me adds a lot of conviction to the overall thesis that Comcast is a great business, a growing business, a company with strong durability, with strong free cash flow conversion, with attractive and growing return on invested capital, a company that operates in essentially a duopoly industry, a company with a very wide moat, and a company that produces a product that is always going to be in demand, and a company with an attractive asset, Peacock, that seems to be growing quite rapidly at 28% as of Q2 of this year. And yet it's trading at under 10 times forward earnings. This to me is it's a very attractive risk-reward imbalance. Again, as a high-quality moated company that continues to compound at a high single-digit earnings growth rate. Wow. And yet it's trading at a very depressed multiple to earnings. The reason why this is happening is because the entire industry has been downbeat. Disney, Warner Brothers, Cumulus, they've all been kicked down because media in general is going through a lot of disruption because of both technology and consumer choices. That continues to rattle the media industry. But as I just showed you, that doesn't apply to Comcast. Because look at this chart. As we can see here, these are the forward earnings growth expectations of Comcast. So the prior slide I showed you the actual earnings. This looks at forward earnings, and you can see how they, change over time. This looks at, this utilizes earnings forecasts from analysts. And you can see a very stark difference. Comcast is unlike the rest of the industry that they get grouped into, because unlike the rest of the industry, it's actually powered forward, while the rest of the media industry has languished on average. And here you can see that the difference, especially over the last 2 years, Comcast continues to grow, and the rest of the media industry continues to languish. But Comcast has been tossed out, kind of like the old saying, right? Tossing the baby out with the bathwater. Because they belong to the media industry, they're getting punished for that. But they don't have characteristics fundamentally, at least not that I believe, that the rest of the media industry is currently battling through. And that's why it makes sense for companies like Warner Brothers and Disney and Cumulus to be going through these growing pains. But again, fundamentally speaking, Comcast is not struggling the way that they are. And so I believe that they are being mispriced simply for belonging to an industry whose growing pains don't seem to be applying to Comcast. And lastly, I just want to end with a little bit of a technical discussion. Now, I'm not the greatest technical analyst in the world, but I do know a couple of classic technical setups. And I believe that this is a bullish setup here. CMCA stock appears to be following a classic bullish technical setup. This is known as the 1-2-3 reversal. And basically what the 1-2-3 reversal says is, and you can definitely Google this, you'll see different examples. But the 1-2-3 reversal chart formation basically looks for a well-defined trend. In this case, a very bearish trend. Good. A bottoming out followed by a counter trend up. And that leads you to point number 2, followed by once again a reversal of that counter trend down to some low point. That's the 3. And then followed by a breakout, meaning the stock refuses to break below that low point. So you can clearly identify 3 points. A clearly established trend, in this case bearish, to a low point, that's point number 1, followed by a bullish counter trend, point number 2, followed by a possible retest of that low, but it never actually retests. So this is the key here. point number 3 should be something above point number 1. That is, the nature of the 1, 2, 3 reversal. And what this then ultimately forecasts is a breakout above that point number 2, which is about $47 per share. And so this, to me, is a very bullish setup as long as we don't break down below that point number 3. If it breaks below point number 3, then this setup kind of technically gets invalidated, but as long as we don't cross below point number 1. Now, it's possible that this is not the true point number 3, and we kind of go back down to 37, 35, 33, possibly. And then it starts a counter turn back up. So it could be that point number 3 is actually down there instead of here. But so far, 37 is held up, and it looks like the stock wants to make a rally off of that. So it does look like this is point number 3. But ultimately, for this chart to hold true, point number 3 needs to be something above point number 1. That's the key principle behind the setup. So if this remains to be the case, then I can see a breakout above $50 a share. And that would be very bullish. It's currently trading at just around $41 a share. So again, this to me is a very attractive risk-reward setup right now. So again, in a nutshell, the Zacks Earnings Certain Proxy is our flagship portfolio that we manage. This is the portfolio that I've been very, very bullish on. I love the principles that the portfolio is built on. We look for businesses that are recession resistant. We look for businesses that have durable moats. We look for low volatility, steady compounders, steady growers over time. And these are some of the businesses that we own. We love them. These are all companies that exhibit extremely high characteristics of quality, and on occasion they go on sale. And Comcast, I believe, is such an example of that. So to recap, the 4 pillars of quality: earnings stability, also known as earnings linearity or earnings durability; earnings growth; return on invested capital; and free cash flow conversion. So here's a couple of examples of companies that we own. Just look for that type of earnings durability, earnings linearity, earnings consistency, and that's why we call it the earnings certain portfolio. Overall, built for long-term durability. So hope you found this helpful. If you have any questions, comments, feedback, anything that I said that's incorrect, or if you have any ideas on future videos that you want me to make, please do reach out to me. You can reach us at 1-866-794-6065, or send us an email to strategycall@zackspro.com. All right, thanks everyone. Take care.